If you are filing your taxes using ITR-4, there's an important update for you to know. The Central Board of Direct Taxes has made investment disclosure mandatory in the revised ITR-4 form. This means you will now have to disclose your year-end investments when filing your returns. So what exactly has changed? From the financial year 2025-26, the government has introduced a new column for presumptive taxpayers under financial particulars of business. Taxpayers must now disclose all investments held up to March 31, 2026. This applies to returns filed for assessment year 2026-27. Such disclosures were not required earlier. With this move, the presumptive taxation regime is expected to become more transparent. But what is presumptive taxation? Let's break it down. This scheme allows small businesses, professionals, and freelancers to declare income as a fixed percentage of turnover without maintaining books of accounts. This is covered under sections 44AD, 44ADA, and 44AE of the Income Tax Act. That brings us to the next question. Who can file under this and which form applies? The return for this scheme is filed through ITR-4, also called SUGAM. ITR-4 can be filed by resident individuals, Hindu undivided families, partnership firms excluding limited liability partnerships, taxpayers whose total income is up to 50 lakh rupees, those having agricultural income up to 5,000 rupees and ownership of not more than 2 house properties. People earning long-term capital gains under Section 112A can also file if gains are up to 1.25 lakh rupees and there are no capital or business losses to adjust or carry forward. Freelancers can also opt for ITR-4 if their gross receipts are within 50 lakh rupees. However, if income from salary, house property or other sources goes beyond 50 lakh, ITR-4 is not allowed. So checking eligibility is important before choosing this form. Experts say that if your investments match your income and savings, you won't face any issues. But if any mismatch is found, it may lead to scrutiny and penalties. If your income is underreported, a penalty of 50% of the tax due may apply. In cases of deliberate misreporting, this can go up to 200%, and any unexplained investments may be taxed at 60%. To avoid any compliance-related issues, taxpayers should report income and investments accurately, ensure consistency between income, expenses, and assets, and check annual information statement, Form 26AS, and bank statements properly. They should also avoid showing low income with high investments without explanation. But what if your investments exceed your income? In some cases, investments may exceed current income due to savings, loans, gifts or inheritance or the sale of assets. So you must have a clear explanation backed by proper documents such as loan agreements, gift deeds or sale records. If you have made an error while filing, there is no need to worry. You can file a revised return within the deadline or file an updated return later with additional tax and interest. But the key is to fix errors as early as possible. Now let's understand how to file the new ITR-4. First, keep documents handy such as bank statements, PAN, Aadhaar and Form 26AS. Log in to the Income Tax e-filing portal. Go to e-file, select Income Tax Returns and then click on File Income Tax Return. After selecting the correct assessment year, confirm your details and enter income under the relevant sections. Claim eligible deductions and review taxes already paid such as TDS, TCS and advance tax using Form 26AS and Annual Information Statement. Now validate the form to check for any errors. Pay additional tax if there is any. At the end, submit and verify using Aadhaar OTP, net banking or electronic verification code. And finally, download Income Tax Return Verification Acknowledgement. The latest update enhances transparency and ensures your income and investments match so that taxpayers do not face any issues. Follow Business Standard for more such deep dives.